Listen, I want you to picture something. A Thursday morning in March of 2025. A kitchen table in a colonial house in suburban Columbus, Ohio. Her name is Margaret. She is 71 years old. She spent 34 years as a public school teacher in the Columbus City School District. She never paid into Social Security during those years because Ohio's teacher pension system, the state teachers' retirement system, is a non-covered pension that operates outside the Social Security payroll tax framework. She did, however, work for 8 summers and 3 additional years in Social Security-covered private sector employment during her education career, enough to accumulate the 40 quarters of coverage required to qualify for a reduced Social Security benefit. Before January 5th of 2025, that Social Security benefit was reduced by the Windfall Elimination Provision, a formula that reduced the Social Security benefit of anyone who also received a pension from non-covered employment on the grounds that the standard Social Security benefit formula, which applies the highest replacement rate to lower earners, would otherwise overcompensate public employees who appeared to be lower earners in Social Security records while actually receiving substantial pension income. Her monthly Social Security benefit under the WEP was $614. Her monthly STRS pension is $3,820. Her combined household income before any IRA distributions was approximately $53,208 per year. On January 5th of 2025, President Biden signed the Social Security Fairness Act, House Resolution 82, into law. The act repealed both the Windfall Elimination Provision and the government pension offset, effective for benefits payable from January 2024 forward. As of February 25th of 2025, the SSA began adjusting monthly benefit payments for affected recipients. Margaret received a letter from the SSA in late February. The letter explained that her WEP reduction was being eliminated and that her monthly Social Security benefit was increasing from $614 to $1,081, an increase of $467 per month, or $5,604 per year. The letter also explained that she would receive a one-time lump sum retroactive payment covering the benefit increase for January 2024 through February 2025, a period of 14 months. The retroactive payment at $467 per month for 14 months was $6,538. Margaret was thrilled. She called her sister in Cincinnati to share the news. She put the letter in a folder. She did not call her CPA. She did not call a financial planner. She received the $6,538 in March of 2025, and her new monthly benefit of $1,081 began arriving in April. Margaret is sitting at the kitchen table in March of 2026 because her tax preparer just handed her the preliminary 2025 federal return, and the number at the top does not look right. The 2025 federal tax liability is $3,840. Her 2024 federal tax liability was $1,240. Her 2025 income was actually lower in total cash terms than 2024 because she had no unusual events, no IRA distributions beyond the usual small amount, no property sales. But her total gross income on the 2025 return is $14,000 higher than 2024. The tax preparer explains that the $6,538 retroactive lump sum and the $5,604 annual increase in Social Security income together added $12,142 to her 2025 gross Social Security income. And because her Social Security income increased, more of it became taxable under the provisional income calculation. And because more of it became taxable, her taxable income crossed into a higher effective bracket than she was in during 2024. The Social Security Fairness Act gave Margaret $12,142 in additional 2025 income. The federal tax system took back $2,600 of it in additional 2025 tax. Her net annual gain from the act after tax is approximately $9,542 per year going forward on the regular monthly benefit increase, with the lump sum tax bite being a one-time cost on the 2025 return. She is not complaining. The net gain is real and meaningful, but she did not know about the tax interaction. She did not plan for the additional withholding. She had no estimated tax payments set aside to cover the gap between what her withholding covered and what the 2025 return showed. She owes $2,600 more than she expected. Without a plan to cover it, she writes the check and depletes the savings account reserve she was maintaining for home repairs. That is the Social Security Fairness Act tax trap. Not a scandal, not an unfair penalty, a predictable, mathematically inevitable tax interaction that affected approximately 3.2 million Americans who received benefit increases in 2025 under the Act, and the vast majority of whom never had the tax interaction modeled before the retroactive check arrived. Smash the like button right now. The SSA processed over 3.1 million benefit adjustments under the Social Security Fairness Act, totaling $17 billion in payments to eligible recipients, completing the process 5 months ahead of schedule. The tax implications of those payments were covered in financial media, but were not communicated to recipients in the SSA benefit increase notices in any detail that would allow a typical retiree to estimate the additional tax liability before filing season. Every like on this video puts this analysis in front of one more affected retiree who is now in 2026 receiving the higher monthly benefit and who has not modeled the ongoing annual tax interaction between the higher Social Security income, the provisional income formula, and the IRMAA 2-year lookback that will determine 2027 Medicare premiums based on 2025 MAGI. Hit it, subscribe, flip the bell. The suits in legal want me to say this is not financial advice. Fine, this is not financial advice. This is a forensic examination of the tax interaction between the Social Security Fairness Act benefit increases, the provisional income formula under Internal Revenue Code Section 86, and the IRMAA Medicare surcharge mechanism for affected recipients. Consult a CPA or fee-only financial planner who has modeled your specific 2025 income picture, including the WEP and GPO repeal adjustments, against the Section 86 provisional income thresholds. What I can do is show you the math. Let me start with the statutory architecture of why the additional Social Security income created a tax impact that many recipients did not anticipate. The Social Security Fairness Act, signed January 5, 2025, repealed both the Windfall Elimination Provision under Public Law 98-21 as amended and the government pension offset under the same statutory framework. The repeal is effective for benefits payable for months after December 2023, meaning the adjusted benefit calculation applies retroactively to January 2024 forward. For recipients who had been subject to the WEP, the primary effect is an increase in the recipient's own Social Security retirement or disability benefit, with the amount of increase varying based on how large the WEP reduction was. The WEP reduction could be as large as $587 per month in 2024, so the maximum monthly benefit increase from the WEP repeal for highly affected recipients approached that amount. For recipients who had been subject to the GPO, the primary effect is an increase or reinstatement of spousal or survivor benefits that had been reduced or eliminated. The GPO reduced or eliminated the spousal or survivor benefit by 2/3 of the non-covered pension amount. For a teacher receiving a $3,000 monthly pension, the GPO reduced the spousal benefit by $2,000 per month, potentially eliminating a survivor benefit entirely if the survivor benefit was below that threshold. The GPO repeal reinstated the full spousal or survivor benefit for affected recipients, with some widow and widower recipients seeing increases of over $1,000 per month, which represents an annualized increase of over $12,000 per year in Social Security income. Now here is the tax interaction. Under Internal Revenue Code Section 86, up to 85% of Social Security benefits are included in federal taxable income once the recipient's provisional income, defined as adjusted gross income plus tax-exempt interest plus half of Social Security benefits, exceeds certain thresholds, defined as adjusted gross income plus tax-exempt interest plus half of Social Security benefits, exceeds certain thresholds. Before I walk through the thresholds, I want to name the specific population the Social Security Fairness Act most affected, because the tax interaction hits differently depending on the type of benefit increase. The WEP primarily affected current retirees who earned Social Security credits through private sector work and simultaneously earned a non-covered pension from public sector employment. Teachers, firefighters, police officers, federal employees under CSRS, and employees in certain states including California, Colorado, Illinois, Louisiana, Massachusetts, Missouri, Nevada, Ohio, and Texas, where significant portions of the state and local workforce are in non-covered pension systems. The GPO primarily affected spouses and survivors of workers in these same systems, particularly widows and widowers who had been receiving little or no spousal or survivor benefit, because the 2/3 offset rule reduced those benefits below zero. For a widow of a covered worker receiving a $3,000 monthly civil service pension, The GPO reduced her survivor benefit by $2,000, often eliminating it entirely. With the GPO repealed, the same widow may now receive $1,500 or more in monthly survivor benefits that had been withheld for decades. The AARP reported that the highest new monthly spousal benefit observed in practice in 2025 was $1,791.50, representing over $21,000 in additional annual income. At a combined federal and state rate of 25%, the additional annual tax is approximately $4,463, leaving a net gain of approximately $16,537 per year. Substantial. At a combined federal and state rate of 25%, the additional annual tax is approximately $4,463, leaving a net gain of approximately $16,537 per year. Substantial. But the $4,463 annual tax was entirely unplanned for every widow who received the notification letter without a financial planner available to explain the provisional income formula, defined as adjusted gross income plus tax-exempt interest plus half of Social Security benefits, exceeds certain thresholds. Defined as adjusted gross income plus tax-exempt interest plus half of Social Security benefits, exceeds certain thresholds. Defined as adjusted gross income plus tax-exempt interest plus half of Social Security benefits, exceeds certain thresholds. With the GPO repealed, the same widow may now receive $1,500 or more in monthly survivor benefits that had been withheld for decades. The AARP reported that the highest new monthly spousal benefit observed in practice in 2025 was $1,791.50, representing over $21,000 in additional annual income. For Margaret, with her pension of $45,840 per year and her Social Security of $7,368, her provisional income was approximately $49,524, already well above the $34,000 upper threshold for 85% inclusion. The additional $5,604 in annual Social Security income from the WEP repeal adds $2,802 to her provisional income through the half of Social Security formula, and adds $5,604 times 85%, equaling $4,763 to her federally taxable Social Security income. The net additional federal taxable income from the $5,604 Social Security increase is $4,763, taxed at her 22% marginal federal rate, generating $1,048 of additional federal income tax per year on the ongoing monthly benefit increase. Ohio state income tax adds an additional 3.5% on the additional taxable Social Security, generating approximately $167 per year in additional Ohio state tax. Total ongoing annual additional tax from the monthly benefit increase, approximately $1,215 per year, on a $5,604 annual benefit increase. Net annual gain from the WEP repeal after ongoing tax, approximately $4,389 per year. Real, meaningful, positive, but substantially lower than the gross benefit increase would suggest to a recipient who has never modeled the Section 86 provisional income interaction. The retroactive lump sum of $6,538 received in March of 2025 is more complex and generated the larger one-time tax bill that surprised Margaret. Tell me in the comments right now. Tell me whether you received a Social Security Fairness Act benefit increase in 2025 from the WEP or GPO repeal. Tell me approximately how much your monthly benefit increased and whether you received a retroactive lump sum payment. Tell me whether you modeled the tax impact before the payment arrived, or whether the 2025 tax return surprised you. Tell me your state. Drop the numbers. I read every single one. We model the ongoing annual tax interaction and the IRMAA look-back consequence together. Before the retroactive lump sum question, let me model a second recipient profile. Meet Gerald. He is 74 years old. Retired firefighter from Sacramento, California. He has a CalPERS pension of $62,000 per year and Social Security income that was reduced by the WEP from $890 per month to $303 per month, a reduction of $587 per month, the maximum WEP reduction in 2024. The Act restored Gerald's benefit to $890 per month. His annual Social Security income increased from $3,636 to $10,680, an increase of $7,044 per year. Gerald is a single filer. His pre-act provisional income, including his CalPERS pension, his reduced Social Security contribution to provisional income, and modest dividend income from his Schwab account, was approximately $70,400. The additional $7,044 in Social Security income adds $3,522 to his provisional income, and adds $7,044 times 85%, equaling $5,987, to his federally taxable income at his 22% federal bracket. In California, there is no state income tax specifically on Social Security benefits. The additional Social Security income from the Fairness Act does not generate California state income tax directly. Gerald's net annual gain from the Fairness Act after tax: $7,044 minus $1,317, equaling $5,727 per year. His retroactive lump sum for the 14-month period from January 2024 through February 2025 was $587 times 14, equaling $8,218. The additional taxable Social Security from the retroactive lump sum, $8,218 times 85%, equaling $6,985. Federal tax on the lump sum at 22%, $1,537. Gerald's net retroactive check after federal tax, approximately $6,681. Both Margaret and Gerald received more money than they had before, but neither understood the specific mechanism by which the provisional income formula would translate the benefit increase into a tax liability before the SSA notice arrived. Now let me address the retroactive lump sum tax question specifically, because this is the most confusing dimension of the 2025 Social Security Fairness Act tax situation, and the one that generated the most reader confusion in the financial planning community throughout 2025. The $6,538 retroactive payment that Margaret received in March of 2025 represents Social Security benefits that were attributable to January 2024 through February 2025. The SSA paid these benefits as a single lump sum in 2025. For federal income tax purposes, there is a provision under Internal Revenue Code Section 86E that allows Social Security recipients to calculate the tax on a lump sum retroactive payment using either the current year method, including the entire lump sum in the current year's income, or the prior year method, also called the lump sum election method, which allocates portions of the payment back to the prior years they were attributable to, and taxes each portion at the rate that would have applied in that year. The lump sum election is made on IRS Form SSA 1099, using the guidance in IRS Publication 915. Every affected recipient should ask their CPA whether the lump sum election was evaluated on the 2025 return. The lump sum election does not actually reopen the 2024 tax return. It is calculated on the 2025 return using a specific worksheet in Publication 915 that determines whether the alternative calculation produces a lower tax. It is calculated on the 2025 return using a specific worksheet in Publication 915 that determines whether the alternative calculation produces a lower tax. Step 1. Confirm whether the lump sum election was evaluated on the 2025 tax return. Ask the CPA who prepared the 2025 return whether Form SSA 1099 was reviewed for the lump sum election analysis under IRS Publication 915. But for recipients whose 2024 income was in a significantly lower bracket than 2025 due to retirement, job change, or other factors, the lump sum election can produce meaningful tax savings. But for recipients whose 2024 income was in a significantly lower bracket than 2025 due to retirement, job change, or other factors, the lump sum election can produce meaningful tax savings by effectively allocating the past year portion of the payment to the lower bracket year. Every affected recipient should ask their CPA whether the lump sum election was evaluated on the 2025 return before assuming the standard current year method was optimal. This is the dimension that is still developing for many Social Security Fairness Act recipients in 2026. And that will continue to develop in 2027. The IRMA Medicare surcharge is based on MAGI from 2 years prior. For 2026 premiums, IRMA uses 2024 MAGI. For 2027 premiums, IRMA uses 2025 MAGI. The Social Security Fairness Act, retroactive lump sum, and the full-year benefit increase were both received and taxed as 2025 income. For recipients whose 2025 MAGI crossed an IRMA tier threshold because of the Fairness Act payments, their 2027 Medicare premiums will be elevated by the surcharge amount for that tier. For a married couple where both spouses are on Medicare and whose combined 2025 MAGI crossed the $218,000 Tier 1 threshold, the combined 2027 IRMA surcharge could be $1,948.80 per year. Add your 2025 Social Security income, including the retroactive lump sum and the full-year benefit increase, to your other 2025 MAGI sources. Compare to the 2027 IR MAA Tier 1 threshold. The 2025 IRMA impact from the retroactive lump sum is a one-time effect that will produce one elevated premium year in 2027, unless the ongoing monthly benefit increase also keeps MAGI above the threshold in 2026 and future years. For recipients whose ongoing benefit increase generates recurring elevated MAGI above an IRMAA threshold, the surcharge will recur in every year that the MAGI remains above the threshold. For recipients whose ongoing benefit increase generates recurring elevated MAGI above an IRMAA threshold, the surcharge will recur in every year that the MAGI remains above the threshold. The SSA Form SSA 44 Life-Changing Event Appeal is theoretically available to recipients whose 2027 IRMAA surcharge is triggered by the non-recurring retroactive lump sum. However, as FedSmith noted in February of 2026, there is not currently a perfect fit between the Social Security Fairness Act lump sum and the specific qualifying life-changing events enumerated on Form S SA 44. The appeal is worth filing with documentation of the one-time nature of the income spike, but the approval is not guaranteed, and depends on how the SSA and CMS treat this specific category of income in the appeals process. Now let me give you the geographic dimension, because the state income tax treatment of the Social Security Fairness Act benefit increases varies across the 8 states that still impose state income tax on Social Security, creating different net gains. In Ohio, where Margaret lives, the STRS pension income is taxable at the state level, and Social Security income is taxable at the state level to the extent it is included in federal taxable income. The additional $4,763 of federally taxable Social Security from the WEP repeal is also subject to Ohio income tax at approximately 3.5%, generating approximately $167 per year in additional Ohio state tax on the ongoing benefit increase. In Texas and Florida, there is no state income tax. The Social Security Fairness Act benefit increase is subject only to the federal provisional income interaction, with no state-level tax amplification. The Texas and Florida recipients' net annual gain from the Act after the federal tax on the additional taxable Social Security is higher than Ohio's net gain by the Ohio state tax amount. In California, there is no state income tax specifically on Social Security benefits. The additional Social Security income from the Fairness Act does not generate California state income tax directly, but the additional MAGI may interact with California income-tested programs and deductions, depending on the recipient's full income picture. In Minnesota, which taxes Social Security income above specific AGI thresholds, the additional Social Security income from the Fairness Act may push a recipient above the Minnesota exemption threshold. The Minnesota exemption threshold for single filers is $84,490 in 2026, creating a new Minnesota Social Security tax liability that reduces the net gain from the Act in the same way that the federal provisional income interaction reduces it. Now let me give you the 4-step action sequence that reduces the net gain from the Act in the same way that the federal provisional income interaction reduces it. Now let me give you the 4-step action sequence. Step 1. Confirm whether the lump sum election was evaluated on the 2025 tax return. If the return was filed without evaluating the lump sum election, ask whether an amended return is warranted if the alternative calculation would have produced a lower tax. Step 2. Calculate the ongoing annual federal tax on the Fairness Act benefit increase. Take the monthly benefit increase from the WEP or GPO repeal. Multiply by 12. Step 2. Calculate the ongoing annual federal tax on the Fairness Act benefit increase. Take the monthly benefit increase from the WEP or GPO repeal. Multiply by 12. from the ongoing monthly benefit increase. Add state tax if applicable. Subtract from the annual benefit increase. The result is your net annual gain. Step 3. Evaluate whether your 2025 MAGI crossed an IRMAA tier threshold and model the 2027 Medicare premium impact. Add your 2025 Social Security income, including the retroactive lump sum and the full year benefit increase, to your other 2025 MAGI sources. Compare to the 2027 IR/MAA Tier 1 threshold. Assess whether a Form SSA 44 appeal is worth pursuing for the retroactive lump sum component of the 2025 income spike. Step 4. Adjust the 2026 withholding or estimated tax payments to account for the ongoing higher Social Security income and the additional taxable portion it generates. If the 2025 return produced an unexpected balance due, the 2026 income picture is likely similar or slightly different based on the ongoing higher monthly benefit. Ensure the withholding election on the IRS voluntary withholding request for Social Security, Form W-4V, is set at a rate sufficient to cover the additional federal tax on the ongoing benefit increase. Most recipients can request withholding of 7, 10, 12, or 22% from Social Security payments. Save this video to your private library right now. Hit the save icon. Add it to the Retirement Survival playlist. Because Margaret received $17,142 in additional 2025 Social Security income from the Social Security Fairness Act, paid $2,600 in unexpected federal and Ohio state tax, depleted her home repair reserve to cover the balance due, and received a benefit she absolutely deserved, but that nobody explained would arrive with a tax bill attached. The net gain is real. The tax interaction was predictable and is now visible. Adjust the withholding. Evaluate the IRMAA exposure. Check the lump sum election analysis on the 2025 return. The Fairness Act delivered what it promised. The tax code delivered what it always delivers when income increases. Understanding both is how you keep more of the money the law just gave you. Subscribe if you have not. Flip the bell. Comment with the amount of your monthly benefit increase, whether you received a retroactive lump sum, and whether the 2025 tax return produced a balance due you were not expecting. Tell me your state and whether you are above any state Social Security tax threshold. I read everything. The Social Security Fairness Act is one of the most significant expansions of Social Security benefits in decades. 3.2 million affected Americans received increases that were long overdue. The tax interaction that accompanied those increases was not overdue. It was as immediate as it always is when Social Security income goes up. Know the interaction, quantify it, adjust for it, keep the net gain. I will see you in the next one. Stay strategic, stay informed. The Social Security Fairness Act gave you more. The Section 86 provisional income formula took some of it back on a schedule that is entirely predictable once you know the mechanics. Know the mechanics. I will see you in the next one. Stay strategic, stay informed. The Social Security Fairness Act gave you more. The Section 86 provisional income formula took some of it back on a schedule that is entirely predictable once you know the mechanics. Know the mechanics.